The headline sounds hopeful. Los Angeles rents just hit a 3-year low. But for most people, that relief still does not feel like relief. That is the twist. Prices are falling, yet the city remains painfully unaffordable. A cooler market is not the same thing as an affordable one. And in Los Angeles, both facts can be true at once. Renters finally have a little more leverage, while many households are still priced out. So, what is really happening here? Why are rents easing now, and why does it still feel so hard to find a place? According to Realtor.com's new Los Angeles rental report, the county's median asking rent fell to $2,520 in the first quarter of 2026. That was down $97 from a year earlier. It was also the lowest countywide asking rent level since early 2022. Zoom out further, and the drop looks even bigger. Since the market peak in the summer of 2022, asking rents are down almost $300. That is not a one-month blip. It looks more like a real correction after the post-pandemic surge pushed housing costs to brutal highs. Realtor.com's economists point to one major reason. More multifamily construction has been adding supply and putting steady downward pressure on rents. And this is not happening in isolation. Realtor.com's national February 2026 rent report said median asking rents across the 50 largest U.S. metros had fallen to a 4-year low. That suggests Los Angeles is cooling as part of a broader national reset, not just because of local weakness. There is also a timing effect here. A lot of projects that were permitted during the building boom of 2022 through 2024 are only now hitting the market. That means renters are finally seeing the delayed payoff from construction decisions made years ago. The biggest declines are showing up in smaller homes. Studios, 1-bedrooms, and 2-bedrooms are seeing more relief than larger family-sized rentals. For 0 to 2-bedroom units, the median asking rent fell to $2,241. That was down 5.7% from a year earlier. Larger units with 3 or more bedrooms fell too, but less sharply. Their median asking rent landed at $3,585. One explanation is the rise of accessory dwelling units, or ADUs. As more of those smaller homes finish construction, they add supply exactly where the market was tightest. Realtor.com says Los Angeles County saw a surge in ADU activity between 2022 and 2024, and a growing share of those units is only now arriving as rental inventory. Think of it like loosening one lane on a clogged freeway. Traffic still moves slowly, but pressure starts to ease where the jam was worst. Los Angeles has spent years making it easier to add these small backyard homes. State and local policy changes help turn ADUs into a meaningful source of new housing. There is another important detail. The data here tracks asking rents, meaning advertised prices for available units, not what every current tenant is paying. So the market can soften for movers, even while many existing renters still feel locked into older leases, renewals, or neighborhoods where turnover is low. Here is the hard part. Even after the decline, the report says a typical Los Angeles rental still requires annual household income above $107,000. That helps explain why falling rents have not transformed daily life for most renters. The numbers improved, but they are still starting from a very punishing level. And the affordability crisis is bigger than Los Angeles alone. The U.S. Census Bureau said nearly half of renter households nationwide were cost-burdened in 2023. That means they spent more than 30% of income on housing. A separate census release in January 2026 found renters paid about $100 more per month in the 2020 to 2024 period than in the prior 5-year period. So yes, the market softened, but affordability is about the relationship between rent and income, not just whether asking prices dipped a little. The countywide average also hides a split inside Los Angeles. Some wealthy cities saw visible declines, while several transit-connected places held firm or even rose. Beverly Hills dropped more than 9% year over year. Malibu and Santa Monica also declined, according to the Realtor.com report. Meanwhile, Pasadena rose nearly 6%. Long Beach gained more than 2%, and Culver City was roughly flat. That pattern matters. Areas with walkable neighborhoods, rail access, and job centers may keep attracting renters even during a broader slowdown. And Realtor.com adds another clue. In 2024, about 86.5% of Los Angeles renters were still living in the same unit they had occupied a year earlier. Back in 2010, that figure was 79%. So mobility has dropped, and fewer vacancies are opening up for people trying to enter the market fresh. Now, layer in policy. Los Angeles recently changed its rent stabilization ordinance to cap annual increases at 4% for a large share of the city's rental stock. According to Realtor.com, that new framework applies to roughly 650,000 units, or about 74% of the city's rental stock. City clerk records for Ordinance Number 188911 show the change became effective on February 2, 2026. For tenants already in stabilized units, that can mean real protection. But it may also deepen the lock-in effect, where renters stay put because moving would cost far more. The Realtor.com research says most Los Angeles renters already remain in the same unit year over year. And the gap between existing contract rent and open market asking rent is huge. That creates a strange market. People with below-market rents cling to them, turnover shrinks, and newcomers fight over a smaller number of available apartments. So, where does this leave Los Angeles? In a better rental market than the peak, but not yet in a truly affordable one. More supply appears to be helping, especially for smaller units. That is a real signal, not just wishful thinking. But the city is still dealing with the aftereffects of years of rapid price growth, limited turnover, and incomes that have not kept pace with market rents. The next phase depends on whether new housing keeps arriving, whether policy protects tenants without freezing mobility, and whether wages can close the affordability gap. For now, the message is simple. Los Angeles renters may finally be getting a little breathing room, but for many households, breathing room is still not enough.